Hey, it's Jim, and this is level 1 of the CFA program, the topic on financial statement analysis, and the learning module on an introduction to financial statement analysis. This is the first in a series of 8 learning modules. And in the next 7 learning modules, we're going to have in-depth conversations regarding the balance sheet and the income statement and the statement of changes in cash flows. And in those future learning modules, we're going to do lots and lots of evaluating, some computing, but a tremendous amount of interpreting. And that's pretty much the emphasis in this very first learning module. Notice this is called an introduction. And so I'm going to give you 3 words to remember in this learning module. And this will go a long way in helping you answer those 16 questions at the end of this module. But this will be a theme that's consistent throughout the next 7 learning modules. Let's think about our role as financial analysts. We're going to rely on the accounting industry to supply us with financial statements, but we're going to demand from the accounting industry that these financial statements are accurate, they are transparent, and they are useful. And that third one, that usefulness of these financial statements, is key in being able to help us as good financial analysts to locate undervalued securities and overvalued securities issued by the firms whose financial statements we are evaluating. Now, the LOSs in this first learning module all ask us to describe. We're going to describe things that are going to lead us to be able to determine whether the financial statements are accurate, whether they're transparent, and whether they are useful. So let's go ahead and start with that first one. Describe the steps. And these are pretty self-explanatory. They're pretty straightforward. What we're going to do is define the purpose and scope. What's the analysis objective? What did I say just a moment ago? To locate under or overvalued securities. That's kind of a global purpose and scope. But what we want to do inside of that is to take a look at, well, let's just pick the income statement. We're going to analyze the revenues, we're going to analyze the operating expenses, and maybe at the bottom, hopefully we have a right-hand balance. Let's call that a net income. What we're going to do to try to make this useful is to make a determination that says something like, all right, what we want to do is we want to say something like the following. At the end of our analysis, we want to determine if that net income at the bottom of the income statement is sustainable. Well, how do we do this? Well, we gather financial statements, we look at industry reports, we read the Wall Street Journal every single day. I say this regularly. My children tell me not to point, but I'm doing it, you guys. Read the Wall Street Journal every day. Relevant economic data. I can't tell you how much brain power I have because of the Wall Street Journal. Keep in mind, I'm not getting paid by the Wall Street Journal to promote its reading. Process data. All right, this is what I was saying earlier about we're going to have to do some computing a little bit. But what's really cool about this process data step is that we are going to link other topics that we're learning inside of level 1. We need to know all about economics. Well, there we go. Inflation and currency differences. We need to know about how to evaluate this data and use it with quantitative analysis and quantitative methods. Maybe we'll collect inflation data. Maybe we'll collect cash flow data for a firm, and we'll perform some kind of a correlation analysis or a regression analysis. And so that leads us into the next step. We're going to analyze all of this data. Now, inside of this financial statement analysis world, we're going to put some number in the numerator and some number in the denominator. And we're going to call those financial ratios. And we're going to look at ratios on profitability, liquidity, solvency, efficiency. We could come up with any kind of a ratio that we want. But there are some standard ratios that are critical. What did I say earlier? We want this financial statement data to be useful. We're going to use this data inside of our economic analysis, inside of our quantitative analysis, and we're going to try to make a determination about whether these financial ratios reflect the profitability or liquidity or whatever those types of ratios are. And in the end, we're going to go ahead and make a recommendation. We're going to say something like, you know what, this company stinks. And it stinks because, well, look at its income statement. It's got tons and tons of expenses. Look at its balance sheet. It's got tons and tons of leverage. Look at its statement of cash flows. Its operating cash flows are negative. We can say something like, let's stay away from this firm on the floor of the New York Stock Exchange. However, let's take a step back here. Maybe we want to short that stock if we think it's going to continue to stink. And then you've heard me say this before, the Institute is super emphasizing the specter of, all right, we've done all this work. Let's go back and review it. Let's go back and monitor it. Let's go back and provide feedback. Well, what does it say down there at the bottom? Ensure accuracy and completeness of analysis and report. So what we want to do is we want to ask all the people around us. We say, hey, look, here's my report. Will you read it? Take it to lunch and tell me what you think. Review and feedback. How about the next LOS? Describe the roles. So here we go down the left-hand column. Here are critical roles. Notice that we can play these roles. We can observe the roles inside of specific financial statements. Some of them lead us to the balance sheet. Some lead to the income statement. Some lead somewhere else. But there are some good examples of investment decisions. Warren Buffett's, assess the performance and growth prospects of Apple. Well, what do we know about Apple? You know, my students, we have a student managed fund at my institution. And my students, they just love their investment in Apple. And they say, you know what, we wish we could have invested in Apple all the way back, 40 years ago, bought one share and it would be worth, millions of dollars today, whatever that turns out to be. So what are my students? They're thinking, Apple, it's always been a good stock. It's always been a good company. And it's probably always going to be. And I warn my students, I say, well, that might be true. But the same could have been said by lots of companies historically that met their demise. So I tell my students, I say, look, you make sure that and we have access to Bloomberg in our trading lab. I say, go to Bloomberg and you look at these financial statements and you see, is Apple still making decisions? Are they still making investment decisions that are going to increase those growth opportunities in the future? How about credit decisions? Let's look on the right-hand side of the balance sheet. What do firms do all the time? They issue bonds, but they also go to the bank and they take out loans. They might have a revolving line of credit. So we want to evaluate those credit decisions. Of course, we want to also evaluate the executive leadership team. The Institute calls it the management assessment here. But let's go ahead and throw in the board of directors as well. We want to decide whether those leaders, are they making good decisions? Are they making poor decisions? One way to do that is to take a look at some of the financial ratios. We'll do this in a later learning module about, we'll call them activity ratios. And then, of course, we want to take the financial statements of one company and compare them to the financial statements of another company. I tell my students all the time, look, when you do ratio analysis for a firm, that's only the first step. The next step is to take a look at what has happened over the last 3 or 5 years to each of those ratios, and then compare those to a 3 or 5 year stream of ratios for the competitor. So you need to do a trend analysis and a competitive analysis. And then linking back to the board of directors, let's take a look at some strategic planning. What is the role of strategic planning that can be assessed inside of those financial statements? And you can get lots of information from the comments from the executive leadership team. You can take a look at the difference between capital expenditures over time. I mean, think about it. If a company has, let's say, $100 in capital expenditures 2 years ago, and $200 last year, and $500 this year, well, what is that saying? That's saying that they're probably investing in wealth increasing projects, and those things are going to pay off if they haven't already. All right, so know those roles, and there are other roles out there, and there are some examples. That makes sense. Here's a good combination statement of a little bit of the income statement, a little bit of the cash flow statement from T-Mobile. And you can see what's provided here is some quarterly data, some year-ended data, and then some comparison over time. This is that trend analysis that I was talking about just a few moments ago. So what we can do as good financial analysts is we can dive into this financial data and make some conclusions. Now, I'm not going to go through each one of these accounts. You guys can pause the video if you want. We'll do this at length in future learning modules and recordings, but I'm going to make one comment here. I want you to look at the bottom. We have quarterly data. Notice that free cash flow. Let me go ahead and define free cash flow for you if you don't remember it from an earlier recording. Free cash flow is the amount of cash remaining after all expenses have been paid and all investments have been made. And so firms that have lots and lots of free cash flow, these are successful firms. They probably have brand name product lines. So look at what's happening here. We go from 1112 to 2065 to 2184. So there's an improvement in free cash flow. So we're thinking, you know what, T-Mobile, they're probably doing something right. But then let's go back and look at some of the individual accounts over here. And we're going to make conclusions that sound like, you know what, we're doing really, really well here, but we might want to look at this particular area right here. Now, look right above the free cash flow, cash purchases of property and equipment. This is that investment in long-term assets. Notice that it increased, but then it decreased slightly. So that's why we have a negative sign over there on the far right column. So this is a kind of a brief description of what the Institute is going to expect you to be able to do on an exam. It will give you a table like this with selected financial data, and they'll say something like, hey, which of the following conclusions about free cash flow or diluted EPS or EBITDA or what kind of conclusions can you make? And so you just look at the trend. Maybe you'll compare it to a competing firm and a competing firm, and you'll be able to make some reasonable assessment. Here's a summary of 3 conclusions that you could make based on some of those numbers here. And these are obvious ones compared to what the media has been predicting. So, of course, if you read the Wall Street Journal, you'll read a sentence every day that sounds something like, oh, the analysts are expecting fourth quarter revenue. The analysts are expecting earnings per share. The analysts are expecting bill-paying subscribers. So look at those 3 quotes from an analysis that's reported in the media, and then you can just go back here and find the relevant data point. Now, one of the things that governing bodies ask companies to do is they say, you know what, whenever you do something important, why don't you tell us about it? So these are called regulatory findings, and there are organizations both inside of countries and outside of countries, supranational organizations. So here's this International Organization of Securities Commissions. Of course, in the United States, the SEC is a part of all this. And so this is a great exam question. 3 core objectives: protecting investors, fair, efficient, and transparent markets. Boy, there's a word I used early on, right? Transparent. And then reducing systemic risk. And what this third core objective is to make certain that when there are risks inherent in the market that are going to increase the probability of a major event. And when I say a major event, I'm not necessarily saying a major spike in stock prices or a major spike in oil prices. I'm talking about failures inside of the market. And those failures or the crisis that they lead to are going to result in lower future values of the portfolios of all of our clients. So this is probably a good question. The Institute could give you a question stem where it says something like, here's an organization and they're requiring that every company publish quarterly data. What is that for? Well, that would be protecting investors. There you go. Timely financial disclosures. I can't imagine the Institute would ask you about which of the following are appropriate securities that are required in the filings. So 10K, I bet you know about the 10K. I bet you know about the 20F. I bet you know about the 40F. I bet you know about the annual report, the proxy statement. One thing I will say about the proxy statement, and the only reason I mention this is because this is one of the questions at the end of the learning module. In the proxy statement, you get lots and lots of stuff that you may or may not find inside of some of these other financial statements. But the proxy statement lists the agenda for the board of directors and for the vote on the board of directors at the next annual meeting. So the proxy statement is pretty much an invitation to attend the next annual meeting, which includes each of the agenda items. And that shows up at the end of the learning module. Now, somewhere in these financial statements, there are going to be notes. And what the notes do is they are added commentary that describes the thought process that goes into all of the decisions that the firm and then the auditors have come up with to try to present the financial statements that are accurate and transparent and useful. So look at some of these explanations for why the notes are so important. So what words do we have in bold? Context, explain the accounting policies and methods. There's an entire learning module on valuation and inventory. So we're going to talk about LIFO, we're going to talk about FIFO, we're going to talk about weighted average inventory method. Maybe we'll even talk about Jim's inventory method. Probably not. But there are tons of ways to value inventory. And so the note is going to say, oh, by the way, this is the method that we chose, and we did it for the following reasons. Now, sometimes we have to make estimates, which means we have to make assumptions. Potential liabilities, this is clearly the case somewhere on the balance sheet where we have pension liabilities. This is an estimate, right? We have no idea when our employees are going to retire. We have no idea what their salaries are going to be on the day they retire. So we have no idea what our potential liability is going to be. So we have to put together some assumptions regarding those potential liabilities and then do the math and compute some present values so that we can say, all right, here's our pension obligation. And in the note, it'll say something like, oh boy, you know what, we really don't know what it is, but to our best of our ability, this is what we're going to record. And this is part of the process that the accounting gods tell us all about. Here's just a quick slide on T-Mobile's notes. So look, we have note 1, note 2, all the way down to note 10,000, and there's a page reference over there. So look, there are notes on things like receivables, fair value measurements, obligations, employee compensation and benefit plans, income taxes, earnings per share, leases, restructuring. All kinds of notes for, almost every line on the balance sheet and the income statement could have an accompanying note. And here's some commentary on these notes. Notice some of the things that we have bolded. Consolidated subsidiaries. All right, so the notes have to tell us, look, this company owns this or this company here and this one over here, and this is how we handled it. Intercompany transactions, that's always important. Oh, notice in the middle, there's that US GAAP, generally accepted accounting principles. Notice that there's not a line in there that says Jim's accepted accounting principles, because who knows what kind of thoughts I might have about debits and credits and depreciation expense. So we have these rules that we have to adhere to, but we can make assumptions inside of those rules. Boy, I really like down at the bottom, we don't have it in bold, but we could have macroeconomic trends. So here's a great example of how the Institute in a question could link some of our macroeconomic data and analysis that we did in a previous learning module to determining whether or not the financial statements are useful. Wow, that's really cool stuff. Now, there's another section in there on management commentary, and so this is like an editorial page. I read the Wall Street Journal every day. So should you. The front page is it's littered with really, really cool current event stuff, and then you work through it. But then when you get to the editorial page in the back, this is kind of like that in the management commentary. And by the way, the Wall Street Journal editors, they have a tremendous sense of humor. I laugh at least 1 or 2 times every week when I read those. It's usually three different editorializations on the back page. They're super funny. I challenge you not to find something worth laughing about in those editorials. All right, why are these so important? That first one, this is exactly what I was saying in the very beginning of this slide deck. Forward-looking disclosures for future performance. This is what I mean about usefulness. But we can get lots of other stuff out of this. The business nature. Didn't we just have a learning module on business models? Well, there you go. Business nature, past results, management strategies and objectives. This links back to the board of directors. This is a super important one. We want to take a look at performance, key resources, and we want to take a look at risks. If you read an annual report, you'll find lots and lots of comments on what kind of risks that the firm is exposed to inside of each of the accounts, typically on the right-hand side of the balance sheet. Boy, we're also going to take a look at operational results. There'll be key performance measures. It's not limited to the financial ratios that I've been talking about for the last couple of minutes. Boy, look at this, trends and events. Boy, off-balance sheet obligations. If you're regular readers of the Wall Street Journal, you'll know that they're on top of off-balance sheet reporting. We'll talk about that some other day. Now, of course, the internal accountants are going to put together these financial statements, and then the firm is going to invite external auditors to come in and say something like, hey, you know what? These financial statements, we either like them or we don't like them. All right, so 2 main objectives of audits of financial statements. Reasonable assurance that the statements are free from material misstatement. So what did I say earlier? I used the term accurate and transparent. So remember material misstatement. That might be a good term to look for on the exam. And then to report on those statements of whether or not they abide by the laws and the rules and the regulations that have been outlined by the accounting gods out there, international standards for auditing. So when the auditors come in, they have 4 choices. They can say, what did I say earlier? This financial statement, it stinks, or we like it, right? So the unqualified opinion, this is what we're all searching for. Fair representation and compliance with accounting principles. Unqualified opinion, that's the good thing. A qualified opinion is one in which, most things on the financial statements are fairly and in compliance, but there might be 1 or 2 deviations. In fact, there's one question at the end of the learning module, I think it has to do with inventory, if I remember correctly. And the question says something like, you know what, the accountants say everything looks good, except we're not quite sure. Maybe they used Jim's inventory method. So we're going to offer just a qualified opinion because we think it's probably fair, but we're not 100% that it's fair. We want to make sure that anybody who uses these financial statements is aware of this qualification so that he or she can make their own judgment about Jim's inventory valuation. An adverse opinion, this is a concluding statement that says something like, you know what, I have no idea what the accountants were doing. They were using Jim's accounting standards through the whole thing. Yeah, so they're not fairly presented, material misstatements, non-compliance. So think about A, B, and C there as different levels. So the first one, the auditors are saying, hey, we love this company. The third one, C, they're saying, we don't like this company. And the B is somewhere in between, but the B is way closer to A than it is to C. And now when I say we don't like, I'm not talking about personality issues. I'm talking about how those financial statements have been presented to the auditing firm. And then the final choice is to say, you know what? We were given like a half of a balance sheet. We were given like a third of the revenues. We have no idea about the bank loans. There's nothing in here about taxes. So we don't have enough evidence to make an opinion. So that's called a disclaimer. So if you look in the red there, this is the T-Mobile, and what does it say down there? Financial statements presented fairly. We like all this stuff. It conforms to the accounting principles. So you can see the verbiage here in T-Mobile's. Now here's an issue that goes all the way back to when I went through the CFA program, which was about 20 years ago. And it goes all the way back to when the Institute began. It used to be called AIMR, and we had this issue of different sets of standards. So inside the United States, we have GAAP, and outside of the United States, we have these international financial reporting standards. And so we need to make sure that if we are comparing one firm that uses GAAP, one firm that uses the international standards, we need to know how to reconcile those two statements. Because, and let's just take a simple example. One firm might have a current ratio. Current ratio is just current assets over current liabilities. That might be 1.1. And a chief competitor over here, let's suppose this is a US company. Chief competitor over here might be a Canadian company, and their current ratio might be 2.3. And you're thinking, boy, why such a difference? These two firms, they're pretty similar in size. They generate the same product lines. They look a lot alike. Why would they have such differences in current ratio? And it might be simply because the international standards are, oh, you have to include this. GAAP standards say, oh, let's go ahead and exclude that. All right, so differing standards, measurement differences, there's the influence on ratios that I was talking about, and there's the global comparison. My advice is to get your phone out. I do this regularly. Take a picture. This is taken right out of the learning module, so this is probably a good source of a question. So down the left-hand column, we've got, what are those? 4 different topics: inventory, research and development, intangible assets, and interest paid on bonds or bank loans. And you can see the differences there. So my advice is just to take a picture, memorize this stuff, because it's probably likely that one of these differences shows up on the exam. Now, let's go ahead and end our conversation. Whoops, I went too far. Let's begin to end our conversation with monitoring developments in financial reporting standards. At the end of this learning module, there's a fascinating conversation about how these different bodies, the US GAAP and the international people, they get together, and their goal is to come together and have a common standard. Well, a lot of times it's difficult to get two people who think differently to agree on something like LIFO or FIFO. So there are going to be these basic differences, but these two organizations, they're working to resolve these differences. But what I found fascinating is the Institute inside of this reading said something like, the CFA Institute sends representatives to all of these meetings. Now, you guys know, watching my videos, I love the simple fact that I passed these exams and that I hold the CFA charter. I'm very proud not only of the work that I did to get through the program, but maintaining my membership. And I love what the Institute is doing in terms of monitoring the development. So what are these goals? Accuracy and transparency, compliance, investor confidence, consistency. These are all things that I've talked about inside of this video. So what we're trying to do here is we're trying to make certain that when things change, that the accounting industry is ready for the change. For example, I know nothing about social media, but Suppose that I'm on my phone and I'm just swiping away, and all of a sudden there's a commercial for something. And I look at this thing and I'm saying to myself, oh, maybe I want to buy that thing. Maybe it's a new tomato plant for my garden. And I'm like, oh my gosh, these tomatoes, these small cherry tomatoes, boy, they look better than my small cherry tomatoes. All right, so how does that firm, how do they handle the costs? How does my service provider, how does my telephone, there's 4 or 5 companies involved in me going out and buying a new cherry tomato plant. So the question then becomes, if the accounting industry is not up to date on social media and advances in technology, then firms are going to be able to massage their data and manipulate their data to make their financial statements look better than they actually are. And then look at those 2 final circle points. This links back to the board of directors and then international standards. So that makes perfect sense. So let's look at this last LOS. What else do analysts use? So issuer sources. We can participate in earning calls. We can go to presentations. We can go to the annual meeting, press releases. We can do any of those issuer sources. We can rely on public third-party sources. Wall Street Journal, social media. Once again, I know nothing about social media, but it probably has lots of good stuff in it. Proprietary third-party sources. Just this morning, when I was in class, I have my students do an assignment in which they have to compute some ratios. So one student said, hey, can I do this using Bloomberg? And I said, sure. So we got on the Bloomberg terminal, and within 5 seconds, we had lots and lots of ratios and way more information than this student even wanted. So we can pay for third-party and we can pay for primary research. And that takes us through these LOSs. So hopefully you can see that what we have done here is we've done lots of describing. When we go to the subsequent learning modules, we're going to do lots and lots of evaluating and interpreting and maybe some computing. So what I want you to do now, go to the 16 questions at the end, and these are super simple. Many of them are just one sentence, like which of the following is most accurate, and you have to pick from among 3 choices. So I'm guessing that you can get through those 16 questions in less than 20 minutes. So I want you to do those. And then use that information and your knowledge base as we prepare for the next learning module recording. So, hey, thanks for watching. I have super fun when I make these recordings. I sure hope they're helping you to prepare for the exam. Have a great day and good luck studying.